Hello and welcome to the Hammond Iles Financial Power Hour. Today we're talking about 6 financial strategies for RMDs you don't need. Now some might say RMD stands for really more dollars to the IRS, but it stands for required minimum distributions. And unfortunately it's one of those things as we get older that we can't avoid. It's a celebration of reaching a milestone in our age, but it also has some required minimum distributions that Uncle Sam wants you to start spending or at least taking some of the money out of your retirement accounts to start to trigger the tax consequences. Now, part of our discussion today is that we're going to go over how we can strategically take those distributions to make a difference in the life of you, your family, and potentially a charitable impact on what you can do strategically with those required minimum distributions. So, as I mentioned, we're going to talk about some required milestones, such as the required minimum distributions in today's presentation. And what if you don't need all of that money for lifestyle or living expenses? Whether it's part or all of your required minimum distributions, there are opportunities for you to utilize them in a more tax efficient way strategically to minimize taxes, grow your wealth, and enhance your legacy. And at the end of today's webinar, we will be having an opportunity for questions. And if we don't have an opportunity to answer your question, or if you're watching this video, you can email your questions to hello@hiwealth.com. So let's talk a little bit about retirement milestones. There are some things in life that we can't avoid. We all get older and reach different ages, and there are some things to be aware of at different ages that we reach these milestones related to our retirement savings. The first is age 55. 55 is an age that if you retire from your employer after age 55, you have the ability to take withdrawals from your 401k or 403b without any early withdrawal penalties. Normally, drawing funds from a retirement account would impact you by having a 10% early withdrawal penalty before age 59 and a half, which is our next milestone. Once you reach 59 and a half, you can withdraw from all retirement accounts, IRAs, 401ks, 403bs, TSA accounts. All of those, TSP or Thrift Savings Plan, not TSA. They're just holding you up at the airport. So Thrift Savings Plans or TSPs if you're a government employer. So employer accounts, if you retire after age 55, you have early access to those funds. And it may be one reason to keep funds in a retirement account after retirement. But age 59 and a half, all restrictions are off on all retirement accounts. You can take money out of your accounts without an early withdrawal penalty. The next age that we have to pay attention to is 70 and a half. Although the Secure Act pushed the required minimum distribution age further into the future, it did not change 70 and a half where you become eligible for qualified charitable distributions. And this can be one of our strategic strategies that we're going to talk about today, and we'll go into more detail in just a little bit. Age 73. So if you're born between 1951 and 1959, your required minimum distribution age will be age 73. So congratulations if you were born in 1952. This is your year that you will be required to start taking required minimum distributions. Now, this year being your first year, you have a little bit of extra time if you choose. The first year that you take a required minimum distribution, you have up until April 1st of the year following the year that you turn age 73. So if you were born in 1952, 2025 is when you turn age 73. You would technically have up until April 1st of 2026 to take your first required minimum distribution. However, you just need to be aware of the fact that if you do defer that first required minimum distribution until that period between January 1st and April 1st of the following year, you also have to take out a required minimum distribution for that year. So you would double up in that year. So there are some circumstances where that makes sense. But for most individuals, we recommend taking your required minimum distribution in the year that you turn the required beginning date or the required age. Now, for those that are born after 1959, so 1960 and forward, you'll get a couple of extra years. They push that age up to age 75 for anyone born 1960 or later. So when we start talking about required minimum distributions, the reason why it's an important conversation is that it's important to be aware of the challenges that can be faced by starting to take your required minimum distributions. Generally, required minimum distributions from retirement accounts are taxable income in the year that you take the distribution. So we need to be aware of a few things when we take that added taxable income. One is just to be aware of where your income tax bracket is. Will your required minimum distribution push you into a higher tax bracket? So if you're close to one of these brackets, it's just important to be aware that that required minimum distribution could push you over, and that you may want to tackle one of these strategies to try to reduce your taxable income. The second is the impact on Social Security benefits being taxable. Now, Social Security benefits are taxed based on what's called your combined income. Basically, it's your adjusted gross income from your tax return. You add back any non-taxable or tax-free interest or dividends, and then you add half of your Social Security benefit. So your combined income, if it exceeds $25,000 as a single or $32,000 as a married couple filing jointly, 50% of your Social Security becomes taxable. So you immediately go from 0% taxable up to 50% taxable. And then the next step is that if that combined income exceeds $34,000 for an individual and $44,000 for a married couple, you then jump up to 85% of your Social Security becoming taxable. So if looking at your tax return, you find that your combined income is just below one of these thresholds, be aware of the fact that a required minimum distribution will not only add to your taxable income because of the income that you're taking from your retirement account, but it can trigger the additional amount of your Social Security become taxable as well. And that can be a big surprise for individuals that occurs for. Now, the third thing to be aware of, as if there's not enough to be aware of for added costs and taxes, is Medicare premiums. So there are another whole set of Medicare brackets that you need to be aware of, whether you're single or married filing jointly or had a household. But for the single and married filing jointly, here are their tables, and it's based on your modified adjusted gross income. So there are still some additional adjustments to adjusted gross income that we were just using for Social Security purposes. And so you might want to also be aware of the bracket and whether you're just under a bracket, and taking your required minimum distribution will push you over. And when that happens, your monthly premium on your Medicare will increase. Now, keep in mind that because of the reporting process of this information eventually through to the government, it does have about a 2-year lag before that increase in income increases your premiums, but you just need to be aware that taking your required minimum distribution may increase your Medicare Part B premiums. So we talked about kind of all of the challenges that taking required minimum distribution or even taking income out of a retirement account triggering additional taxable income could impact you. So let's talk about some of the strategies. So if you have required minimum distributions, whether you need just part of it or don't need any of it as your living expense, what we want to look at are some strategies to continue to keep that money working for you. When we put together a financial plan, a couple of the biggest impacts on the success of a financial plan is one, inflation. Is your portfolio and net worth going to keep up with inflation? The second is income taxes on impacting that picture. So these strategies are looking at ways that we can continue to grow and outpace inflation and ways that we can reduce income taxes. So this first strategy is just keeping up with inflation. When we take money out of a retirement account, for especially if it's required minimum distributions, which you may not need, you don't have to spend it. And it's not wise to just leave it sitting in a checking account or a bank account where it's earning minimal interest, where over time it's losing value to inflation. So our first strategy is just to reinvest it. So your minimum distribution comes out of the retirement account. Certainly it will be taxable, so you may have taxes withheld when that money is paid out, or you may pay taxes through quarterly payments or with your tax returns. So the net amount, you could turn around and just reinvest it in an after-tax investment account. You can put that money right back to work for you. And some of the advantages of doing that is that you're not losing purchasing power to inflation. Because a diversified portfolio invested in the financial markets is one of the best ways to outpace inflation. It puts that money back to work for you to grow and outpace inflation. It also gives you the flexibility to invest as you choose. If you're especially taking money out of an employer retirement account where your employer controls the investment options that are available to you, investing outside in an investment account can be a great way to diversify your portfolio and invest as you choose. You also get to maintain control over when to recognize capital gains. So unlike a retirement account that generally is taxable income when it comes out to you, a taxable investment account is only taxed on the interest and dividends it earns, or eventually when you sell investments, you're taxed on the appreciation of your investments as a capital gain. And those capital gain rates are lower than income tax rates. So long-term being that you held the investment more than 1 year, it will be taxed at a long-term capital gains tax rate. Also, it allows you to just continue to keep that money working for you, which can potentially continue to grow your wealth overall. So moving on to strategy 2, as we mentioned about the age of 70 and a half, where this strategy becomes available to you, is when you have the ability to make a distribution directly from an IRA to a charity, and by doing so, it's not taxed as income. It comes out using your pre-tax dollars for charitable purposes with no tax consequences. Now keep in mind that this only applies to traditional IRAs. So if you have money in a 401k or a 403b or another employer retirement account, you can't use a qualified charitable distribution from that account. You would need to roll part or all of your retirement account over to an IRA before you could then make a qualified charitable distribution. Now, some of the advantages, as I mentioned, is that QCDs are excluded from taxable income. And keep in mind that because it's excluded from income, it has a double benefit if you live in a state that has a state income tax. So that $10,000 gift from your IRA to charity, not only is it not reported on your federal income tax, but because most states use your federal adjusted gross income to report and calculate your state income tax, it's also avoiding state income tax. So you get a double benefit there, in that it avoids both federal and potentially state tax, depending on where you live. Now, because it's not reported as income, it's not deductible as an itemized deduction. But for most taxpayers that are now claiming the standard deduction, itemized deductions aren't impacting taxes. So this is a way of getting a tax benefit from your charitable giving, even though you're using the standard deduction. And then last, kind of as an added bonus, is a qualified charitable distribution counts towards your required minimum distribution. Now, keep in mind, you don't have to give away your entire required minimum distribution. So, for example, if you are required to take $10,000 out of your IRA, you could give $5,000 to charity and keep $5,000 for yourself, or any mix, and it can be more than one charity in your charitable giving. This year, in 2025, the amount that you're able to give as a qualified charitable distribution is $108,000. That amount will be indexed for inflation, so it will go up each year going forward. So for someone who wants to make a big impact, there is a way of making a large charitable donation from a retirement account. But it is a great way of meeting your required minimum distribution while still making your charitable donations. And keep in mind, even if you need funds from your RMD for living expenses, this can still be a great strategy to implement. Even though I might need that $10,000 out of my IRA to live on, if I already intended to give $5,000 to charity, I would, rather than writing the check out of my checking account for $5,000 to the charity, I'm much better off giving that $5,000 out of my IRA and having that pre-tax money go directly to the charity so that I have less income tax on it. So I keep more money in my pocket. So this is a great strategy, whether you live on your required minimum distribution or not. Strategy 3 is to consider using life insurance to inherit your legacy. Many times as I talk to clients about wanting to leave a legacy to their children and grandchildren, or maybe to a charitable organization, the challenge is that if you want to leave, say, $100,000 to charity or to your kids, in most cases, people think, well, that means I have to take that $100,000 and I have to set it aside, not spend it, so that I can pass it on to my children or grandchildren. However, we can look at using a smaller amount to leverage it by using life insurance. Using some of the required minimum distribution to fund a permanent life insurance policy can be a great way of leveraging that money that you have to take out for a larger income tax-free inheritance for your family. Generally, life insurance policies, the death benefit is income tax-free. If you have an estate that's large enough that you are concerned about estate tax, then you can structure a life insurance policy to be owned by an irrevocable life insurance trust or owned by the beneficiaries directly, so that it's excluded from your estate, so that you avoid estate tax as well. And as I mentioned, you can combine it with charitable strategies so that you can make a maximum impact. Let me say that again. You can combine it with charitable strategies for maximum impact, both on your family as well as your charity that you want to support, or charities. And let me just share with you one of my favorite strategies of doing that, and what we call double the impact of your retirement savings. So this is an example of Arthur and Michelle. Arthur has $1 million IRA, and I just want to put a pause right there and say, I'm using $1 million as a round number. It doesn't mean you have to have $1 million to use this strategy. You could have $100,000 or $500,000, whatever your IRA balance is. You can adjust these figures to match your scenario. But in this example, Arthur has $1 million IRA, and both Arthur and Michelle have just reached that beautiful age of 73 years young. And now Arthur, being 73, is required to start taking in minimum distributions. And thankfully for them, because of his pension and their Social Security, Arthur and Michelle don't need the required minimum distribution for income. So when we talk about, well, what do you want to accomplish? Arthur and Michelle said, well, I want to leave a legacy gift to our kids and grandchildren. We want to pay as little as possible in income taxes for themselves and for their kids. And that's one of the things we'll talk a little bit about on leaving retirement accounts to kids and why these strategies are important. Also, it's creating an impact on their favorite charities. So let's take a look at their picture. So again, we have $1 million retirement account. So in that first year at age 73, Arthur is required to take out a minimum distribution of roughly around 3.8%, or $37,736. So from that, he pays income taxes. So assuming a 22% federal tax bracket and 4.6% for the state of Connecticut, he's going to pay about $10,000 in income taxes. So now implementing this strategy with life insurance, what we do is we're going to use $25,000 for an annual life insurance policy called an Index Universal Life or Second to Die life insurance policy. What I mean by a second to die life insurance policy is that the death benefit, in this case $1 million, does not pay out until the second spouse passes away. So they'll pay this premium each and every year until they're both gone. And when they both pass, $1 million will be paid out. And it'll be paid out to their beneficiaries, in this case, their children and grandchildren, and it will be income tax free. One of the nice things about establishing a permanent life insurance policy is that this premium is locked in and will be the same each and every year. So in this case, in this first year, there's still about $2,000 left over that they can spend as they wish. And each year, as the required minimum distribution rule requires that minimum distribution to get potentially bigger every year, the amount that they'll have left over to spend will increase as well, since the premium remains the same. So by taking part of that required minimum distribution, they've now taken money from a $1 million taxable account and created $1 million of tax-free benefit. Because if the kids inherit that $1 million, they're not going to receive $1 million. That's all taxable income, and they'll pay income tax when that comes out. And because of the new Secure Act rule, non-spouse beneficiaries will be required to take out that entire retirement account within 10 years. So if you have one child, they're going to have to take out $100,000 a year, probably more than that to keep up with the growth, to drain it out over a 10-year time frame. So it could have a substantial tax consequence, especially if your children inherit a retirement account when they're hitting the prime of their own earning years. It'll be taxable income on top of it. So this is one way to look at having a tax-free benefit from a life insurance policy, whether that's to replace the retirement account or just provide additional money to come back to them to pay the tax on the retirement account. But in this case, Michelle, his wife, is named as the primary beneficiary. So each year, the account's going to continue to grow, and hopefully through the growth of the account, it's going to keep up with the minimum distributions. So the account balance will remain at $1 million or higher, potentially. And what they've done is they've named charities as the contingent beneficiaries. So eventually, when both of them pass, their intent is to leave the retirement account to charity. And why is that important? Because now the nonprofits receive 100% of that retirement account income tax free. So at the beginning of this scenario, we started with $1 million retirement account that's not really $1 million. After income taxes, either to Arthur and Michelle or to their kids and beneficiaries, it's going to be less than that. But the end result of this strategy is we've now created $1 million for the family, income tax free, and we've created $1 million or whatever the value is of that retirement account, income tax free. So this strategy has basically disinherited Uncle Sam that will not receive any income taxes except for what he's collecting as the minimum distributions come out each year. So this is a great way to create a larger impact from a retirement account. So I see one question is can we use the RMD to pay the premiums on in-force or existing life insurance policies? Absolutely. Required minimum distributions that come out once you've paid income tax, you can use it for anything that you would find beneficial, whether that's paying the premiums on existing policies or using one of the other strategies that we're going to talk about today. Great question. So strategy number 4, pay taxes on Roth IRA conversions. And this again is something that is becoming more and more of an important issue as we talk about the impact, not necessarily on you as the owner of the IRA, but on your beneficiaries. Because when your beneficiaries inherit your IRA, because of the Secure Act, they will be required to take the full IRA balance out within 10 years. So one of the ways to minimize or start to reduce the impact of that is to convert part or some or all of your IRA from a traditional IRA over to a Roth IRA. So with your traditional IRA, when you reach age 73 or potentially 75, depending on the year that you were born, you will be required to take out a required minimum distribution. And if you're past those ages, you'll be required to take out your minimum distribution before you can make a Roth IRA conversion. So then part or all of the funds from an IRA can be converted over to a Roth IRA. And the advantage of the Roth IRA is that you pay tax on the money before it goes in. It grows tax deferred inside the Roth IRA. And then it comes out to you or your beneficiaries income tax free as long as you're over age 59 and a half and have held the Roth IRA for at least 5 years. This is one of the reasons why even if you're saying, well, I don't want to make a big conversion of my IRA to my Roth IRA because I'm still working and I have a higher income, I would recommend considering converting just a small amount, say $1,000, $5,000 over to a Roth IRA to start that 5-year clock going if you don't already have a Roth IRA. So the Roth IRA has the benefit that it grows tax deferred, and after 5 years and 59 and a half, it all comes out tax free. Now, as I mentioned, when you do make the conversion, it will trigger a taxable event. So if you convert, for example, $10,000 over to your Roth IRA, that $10,000 in the year that you convert it will become taxable income to you, and you will have to pay income tax on it. One of the rules of thumb that I personally recommend is when you convert amount to a Roth IRA, I would recommend converting an amount that you have the ability to afford and pay the income tax on outside of the Roth IRA. Could you have taxes withheld at the time that you convert it over? Yes, you can. However, the goal of the strategy is to get as much as possible into the Roth IRA. And so ideally, you'd pay the tax outside of that. And that's where having the required minimum distribution can come in handy. So paying the tax outside of it using those required minimum distribution funds can pay the taxes, allowing the full amount that's being converted to go into the Roth IRA. So as I kind of show here with that last arrow, and that using that required minimum distribution can pay the tax on that. So the benefits of the Roth conversion is that the Roth IRA provides tax-free growth and withdrawals to the account owner and beneficiaries. And in my personal opinion, everybody should have a Roth IRA. If you have a child, grandchild, everybody should have a Roth IRA. If they have earned income, they can make a contribution. The nice thing about a Roth IRA is that the contributions can be taken back out at any age. So unlike a traditional IRA that we talked about, the important age of 59 and a half being needed to be reached before you could take money out, unless you meet one of the special exclusions. Having a Roth IRA, you can always take your contributions or the amounts that you converted out. So even if you convert and you need that money within the 5 years of starting it, you can take the contributions or the conversion amount out within that 5 years. It's just the growth that has to stay within the account. So this is a great way for kids to inherit funds that will become tax-free for them. So it's also a way for you to potentially reduce your future RMDs. If you don't need your required minimum distributions for income purposes, by converting more of your IRA to a Roth IRA, because a Roth IRA comes out tax-free, there are no required minimum distributions on a Roth IRA. So by converting and lowering that IRA balance, it will reduce the amount that you're required to take out in the future, which again could potentially reduce the taxable income, which then could reduce your Medicare premiums and taxation on Social Security. As I mentioned, no required minimum distribution rule on Roth IRAs, so you can leave that account and just let it grow and pass on more tax-free assets potentially to your heirs. And also it creates the opportunity for you to do some retirement income planning. So because distributions from a Roth IRA come out tax-free, if you find yourself that you're close to one of those brackets, either for Medicare premiums or for the taxation of Social Security or even your income tax bracket, by having part of your retirement funds in a Roth IRA, it allows you to mix and match where you're taking your income from. So if I am just over a bracket for my income taxes, for example, I could decide that rather than taking most of my income from my taxable retirement account, I'm going to take part of my income from my Roth IRA, reducing my taxable income so I can get into that lower tax bracket, or reducing my Medicare premiums or Social Security being taxable. So it can be a great way to also assist with retirement income planning. So now we're up to strategy 5. And strategy 5 is to fund a 529 plan. So if you have a real interest in providing for the education of your children or grandchildren or great-grandchildren, funding a 529 plan or a college savings account can be a great way to use those required minimum distributions. It leaves a legacy for education by using your RMDs to fund those college plans. It's not federally tax deductible when it goes in, but it does grow tax deferred, and the withdrawals for qualified education expenses are tax free. Also, some states offer tax deductions. For example, here in Connecticut, if you contribute to the CHET plan or the Connecticut Higher Education Trust plan, you could deduct up to $5,000 per person on your taxes. For a married couple, it's up to $10,000. So you can get tax deductions or credits depending on the state in which you live if you use your state's 529 plan. Also, a part of the Secure Act 2.0 is that there are some new rules for unused college saving funds in a 529 plan. So there are some specific conditions for that, but the unused 529 plan can potentially be rolled over into a Roth IRA if children don't use it. One of the requirements is that you have to have the 529 plan for 15 years. So if you have children or grandchildren that have young children, encourage them to get started on starting that plan. Again, even if you just get the plan started with a minimum amount, you can help with that 15-year time frame potentially that could be required down the road. So our sixth and final strategy is to give gifts to family. Many individuals that don't need required minimum distributions for their own living purposes say, well, I want to impact my family and I want to see the impact of my giving while I'm living. And so you can give up to $19,000 per person per year without any tax consequences or any tax reporting. And you can gift either cash or you could give appreciated investments. And as a married couple, it's twice that amount, so you can give up to $38,000 per person per year. So it also can be a way of just gifting money if you don't need it for your own purposes. So those are the 6 strategies to utilize required minimum distributions that you don't need, whether it's part or all of your required minimum distributions. So 3 key takeaways from today's presentation. First is to work with a financial coach and your tax professional to help you choose a strategy that's right for you. It's important to be informed on where you stand relative to the income tax brackets, the taxability of your Social Security benefit, as well as your Medicare premium. And so that's why we want to involve your tax professional. Required minimum distributions should be seen as an opportunity. There are so many things that you can do with required minimum distributions. Again, another term that is really more dollars to the IRS. It's not just a requirement, it can be an opportunity to make an impact. And through the prudent use of RMDs, you can continue to grow your wealth, lower your taxes through proper planning, and leave a lasting legacy. Now, for those of you that may not be clients of Hammond Iles Wealth Advisors, I just want to take a minute and explain how we can help. We offer free conversations with a financial coach. You just go to our website at hiwealth.com and you can schedule a free conversation at your convenience. One of the things that's unique to Hammond Iles is that we believe that everybody starts from zero. We all start from zero on building our net worth, and so we have no minimum investment amounts. And so encourage your children, grandchildren, or anyone that you know that's just getting started or wants to get started with investments to reach out to Hammond Iles. We offer continued online financial power hours like this on a monthly basis. You'll find those listed on our website, as well as the recordings are in our YouTube channel. You can also follow us, connect, and like us on social media so that you get more updates on when our education and content rolls out, including our weekly 60-second Financial Friday videos. We also have additional resources on our Hammond Iles website. One of the popular tools is the Family Inventory Workbook, a downloadable guide that allows you to consolidate all your financial information into one central place. So if something happens to you or if you're incapacitated, that your power of attorney or your family members can find your information in one central place. Also, if for some reason you experience a loss in your family, we also have a guide of the 20 things to do after a loved one passes away. So there's some great resources on the website, and I encourage you to check those out. At Hammond Iles, as I mentioned, we do not provide tax planning. We encourage you to reach out to your tax professional with determining which strategy may be most appropriate for you, and we're here to help. So please feel free to reach out to us either through phone, send email. If you have any questions, can come to hello@hiwealth.com, and you can also reach out to us through our website at hiwealth.com. We have 4 offices, 2 in Connecticut, 1 in Virginia, and 1 in Vermont. And we also serve clients around the country. So wherever you're joining us from, we can assist you. So with that, I'd like to just break for questions. And so if you have questions, again, I'll be happy to take them through the chat, or you can raise your virtual hand and I can unmute you to ask your question. Also, if you'd like to just follow up with us personally about your situation, you can reach out to our office or email your questions to hello@hiwealth.com.